Good afternoon, welcome to the Market Wrap number 106. Stuart Williamson here at the helm. Thank you very much for joining. We're here to share our views, just our views, no one else's, and what we think is a good idea or not a good idea to buy in the UK. Thank you for last week for all those lovely comments about me drinking from a cup. That's because I had a bad throat. Okay, this week we're talking about hysteria in the UK press over the buy-to-let market collapsing for landlords. Is the investment market going to tank? That's what people are saying, if you look at all the headlines. But our question, is it justified? Let's look at all the facts and figures and see what comes out. Okay, look at the headlines. Landlords will lose money by next year as buy-to-let Britain falls apart. Really? Why the holiday let property market is about to collapse. The end of the staycation boom. Tourists are looking abroad. That's possible. All right, there's a surplus of holiday properties and councils are trying to tax them. So that is potential. Another headline, my buy-to-let profits are disappearing before my eyes. One landlord's mortgage has increased 6 times in 6 months. And it's true, it has occurred to some people. But the real sane people out there are saying there won't be a house price crash, but beware a buy-to-let dip. Okay, because there's 2 reasons for that. Property markets only take a dive when you have a very high unemployment rate and you have very high interest rates. So, is that what we have at the moment? Basically, we have interest rate rises and a government meddling with profits. That will cause problems. So, is there a real rationale for this negativity? These are the facts. Buy-to-let yields have hit record lows, fueling fears that property investors will sell up. Landlords could soon turn a loss as higher interest rates bite. That is true. The government's buy-to-let tax crackdown, which started 5 years ago, has further amplified the pain of soaring mortgage costs. Nationally, gross rental yields are already at a record low of 4.38%. This is because house prices have climbed more quickly than rents. 4.38%. If that's an average, you compare that to London, that's not so bad really. The research consultancy Capital Economics has forecast that by the end of 2022, yields will have hit a new low of 4.26%. As interest rates rises push up landlords' outgoings, next year the margin between rental income and mortgage costs will become the most squeezed it has been since the financial crisis. Again, put it into context, the most squeezed since the financial crisis. We had 40 years of increasing house prices, and we're looking at a short-term period. The Bank of England's decision to increase the bank rate to 1.25% will cause the average net profit on a new buy-to-let property to fall by 15% for a landlord who pays higher rate tax, according to Hamptons. In London, an investor who pays higher rate tax will see their net profit fall by £840 a year. That's 29% less than before the rate rise. So these are, taken in isolation, quite damning figures. And it said that it'll only take the bank rate to reach 2% before the average landlord on a higher rate tax bracket would see their profit more than half. And this is according to Anisha Beveridge of Hamptons. In addition, Capital Economics has forecast that the bank rate will possibly hit 3% next year. But a typical buy-to-let will be a lot sooner in a loss-making territory. An average landlord on the higher rate of tax will see their investment turn a loss if the bank rate hits 2.75%. At this point, a typical buy-to-let mortgage rate would be 4.11%, meaning they would lose £97 per property per year. At 3%, the annual losses would jump to £403. Now, looking at the last 40 years of house price growth, and you're looking at a £400 loss per annum, I think we've had it pretty good, and that would be taken into consideration. But yes, in principle, it is a loss. The London landlords will be hit hardest, according to Ms. Beveridge. Here, profits will fall by 59% if the bank rate rose to 1.5%. If interest rates rise to 2%, a typical London landlord would lose £501 a year per property. At 3%, the loss would be £2,180. These are all facts, and the government's buy-to-let tax crackdown is key to it all. Previously, landlords could deduct mortgage costs from their tax bill, and it was scrapped from 2017 in phases. However, you can still do it if you have a company and you buy through a company, an SPV. Also, offshore, we have more tax benefits. Since April 2020, landlords have only received a 20% tax credit on their mortgage interest payments. This means that rising mortgage costs now hit landlords' net profits much quicker and much harder. Demands from investors will drop off as they turn to alternative investments, says Andrew Wishart, great guy, we've quoted him lots of times before, from Capital Economics. And this is another good reason to think house prices will decline until rental yields look more attractive. He goes on to say the wholesale exodus of landlords from the market would force down house prices. Okay, the wholesale exodus of landlords. Now, Michael Gove, that great politician, housing secretary, has also begun an overhaul of the rental sector, which he plans publishing next week to ban landlords from discriminating against tenants on benefits with pets. As I said last week, if you've got an eagle or a sloth, you can take it in if you wish. They'll be introducing a new minimum standard for private sector rental properties and allow tenants to reclaim rent for low quality homes. Section 21 no-fault evictions will also be abolished. I mean, this is all crazy stuff. You know, it is very much betting on the side of the tenant, which does need to be protected, but not at all costs. We've got some quotes from existing landlords. There's one gent who had 65 properties across southeast London who says, since the tax changes, we basically don't make a profit. And as rate rises go up, they will certainly eat further into this, although the agent, the person managing it at the moment, has got fixed rate loans, which means that he's not been affected. And this is one of the key points, which we'll come on to shortly, is that fixed rate loans are what is protecting the UK market to a certain extent at the moment. Landlords in cheaper areas, not southeast London, where yields are higher, will be more protected than in London, but rate rises will still take their toll. If the bank rate increases up to 2%, net profits for a higher rate taxpayer in the northeast will fall by 37%, and in the northwest they could drop by as much as 67%. So what is the contra-argument to this? The contra-argument is simply that the impact of rate rises will be partly offset by rising rents as tenant demand continues to be high, but landlords on variable rate mortgages cannot necessarily respond quickly enough to this, and are not allowed under law to increase, I think, rates by more than once a year. In Zupa's report we covered last week, we talked about the number of landlords that are on fixed rates, 79% currently. In addition, wage growth is still going through the roof at the moment. There's a massive shortage of staff. You see people being advertising new staff all the time. Wage growth is growing at 8.8% each year. To put it into context and then go on to the more positive side of it, Capital Economics crunched the numbers, and based on medium income earning household with an 80% loan to value mortgage buying a property at the UK average, the cost of servicing of the loan rises from £881 a month with a bank rate of 0.5% to £1,094 if the rate is increased to 3%, or from around 40% of disposable income to around 50%. With everything else inflating away like there's no tomorrow, that's quite a squeeze on these houses. But this is the point. Is it enough to cause a wave of forced sales, which is what is essentially required to induce a market crash? Now, yes, there'll always be households who can't cope and fall into arrears. There may even be a marked rise in foreclosures. But as Mark Carney, the former governor of the Bank of England, once observed, however hard things get, British households would do almost anything to keep paying their mortgages. And that's the truth. You know, the last thing that goes out the window is the mortgage payment. Because you've got nowhere to live, you know, you really are in deep doo-doo. That's why banks are so keen on mortgage lending. There is no form of lending which is safer. Despite very high levels of household indebtedness, there are in fact very, or relatively, few UK mortgage defaults during the 2007-2009 financial crisis. But this didn't stop regulators confusing a banking meltdown caused by the subprime lending in the US with perceived excess in the UK housing market, and clamping down, therefore, on UK mortgage lending accordingly. As we know, it has been difficult to get a mortgage ever since. Rigid rules on job security, minimum deposits, loan-to-value levels, and loan-to-income rules are routinely applied, making the market so much more resilient to upsets, which is not what we have in the US, hence why their interest rates are going through the roof. So don't expect a flood of cheap properties coming onto the market as a result of higher borrowing costs. Much more likely is people just sit it out and make do. The other precursor to an outright crash is rapidly rising unemployment. This is possible. But you look at the market today, and it is nothing like that. With the labour market as tight as it is today, it seems unlikely that we'll have that problem. Also, property supply is tight. With the government having again ducked meaningful planning reform, it doesn't look like it's going to get easier. The ranks of property seekers is, however, more likely to be swelled and to be more demand with the arrival of an estimated 100,000 Hong Kongers. And that's something we're seeing offshore. A lot more Hong Kong people buying into the UK, just as bolt holes, not even to live in. Even with higher interest rates and somewhat higher unemployment, it's hard to see a let-up in demand. Okay, potentially the issue in those admittedly quite rosy, tinted glasses views is the buy-to-let market, which may well experience quite a bit of selling pressure as interest rates rise. Many of the attractions of buy-to-let have been ripped away by ministers determined to tilt the playing field back in the favour of owner occupation, which is where we're going with this Section 21, with the thing about pets, with all those sorts of things, which is fair enough. I can see their points. The further strengthening of tenants' rights, to go with the cost of enforced environmental protection, so the EPC certification, will be the final straw for many landlords, because it's going to cost you 10 to 15% of your house value to get it to EPC standard C or above. Why bother? But private landlords might be going, but there is no shortage of corporate and institutional investors with the economies of scale needed to absorb those costs, willing to step into the breach. As it happens, a steep rise in interest rates might not be such a bad idea, potentially. So never mind resurgent inflation, there are almost as many net cash savers in the UK as borrowers. So they would be big beneficiaries, and we would see a lot more wealth coming into the economy because of that. First-time buyers might also benefit if the effect was to induce a crash, making price of ownership more accessible. But we don't believe that's going to happen. The corrective action of this sort is not at all what the Bank of England or Downing Street has got in mind. They want neither a recession nor a house price crash. It's not in their interest. And frankly, that is our view at APW, is that they will avoid both, and the market therefore will not tank, and the end of the world is not nigh, and the hysterics we're getting are just that, hysterics in the marketplace designed to sell newspapers and ad space. Thank you very much. Please do like, subscribe, share. It's our view, that's all. If you don't like it, don't like it. That's okay. All the best. And by the way, where am I calling from today?